After only 1 year, one tax year, of experiencing the £5,000 dividend allowance, this budget that we've just heard, the spring budget, the Chancellor's last spring budget, announced that that allowance is going to reduce to £2,000 in 2018, the 2018-19 tax year. The reduction in the allowance is going to apply to everybody receiving dividends, that is, regardless of the source of the dividends, whether it's your own company or whether it's just an investment. And in relation to investors, what does this do? Well, it reduces the attraction that we've had for 1 year of holding money outside of tax wrappers, the dividends from which will be completely tax-free. Of course, it reduces the attraction because the amount has fallen. It hasn't fallen yet, it won't be until 2018, but it still represents a very strong story, the £2,000 allowance, for advisors to communicate to their clients. Right now, it means that, say you had a dividend yield of around 3%, the £5,000 allowance would imply £150,000 could be held in investments outside of ISA and pension tax wrappers, and the dividends produced will be completely tax-free, together with the CGT allowance of £11,100 in the 2016-17 tax year, going up to £11,300 in the 2017-2018 year, means that that sort of portfolio would generate completely tax-free returns with a bit of smart management. Now, when we come to 2018 and 19, the story is not so strong for those unwrapped investments because the allowance is falling to £2,000, assuming that gets legislated. But that still does mean, if we're looking at a 3% yield, we can be looking at over £60,000 that can be held in an account outside of the tax wrappers, pensions and ISAs, just in unit trusts or collectives, and the dividends will be tax-free. And of course, we still have the CGT allowances. So that story is still very strong. Don't forget the ability to hold unwrapped investments outside of tax wrappers that will generate further tax-free income and gains. And the amounts are not insubstantial. We're looking at, again, yield dependent, for a couple over £100,000 held in that way. Definitely a story worth remembering, and that's really the powerful thing that comes from that £2,000 reduction. The reduction to £2,000 is to just reaffirm the power of actually even having that allowance. Now, what if the dividends you receive exceed £2,000 or £5,000 now? Well, as I've discussed in the past, then it could be worth looking at the tax protection that an investment bond could give you. The choice isn't binary. There are a number of factors to take into account, but the rates have increased, did increase the last tax year, or the 2016-17 tax year, by 7.5% for basic rate taxpayers to 7.5%, for higher rate taxpayers to 32.5% on the net dividend, and about 38% for additional rate taxpayers. So when the dividends are taxed at those sort of rates, once the dividends exceed the allowances, the 5,000 now and 2,000 to come, then the bond can represent a very effective tax deferment vehicle, all other things taken into account. If you like that and the amount you've invested is significant and the amount along the period you're going to invest for is reasonable, then the investment bond can be worth looking at. There's no doubt that the dividend tax allowance, at whatever rate it stands, just makes it harder to justify the tax deferment advantages of an investment bond, UK or offshore. However, those advantages do still exist once you exceed the dividend allowance. It's one of those things that it's not all one way or the other. It depends on the facts of the case. But for dividends up to the allowance, it's probably unwrapped collectors. Once you look over that allowance, then it can be worth considering an investment bond. And that will definitely be the case for SME owners who remove money from their business by way of dividends, who won't have an allowance left, and trustees who just don't qualify for the allowance.